In this section, we will talk about the CF investment process, which is followed by a typical lender. The first is the deal sourcing. Typically, the CF deals are sourced from independent chartered accountants, boutique investment bankers, and established international property consultants like JLL, Anrock, etc. We have also seen that the lenders do repeat transactions with their existing developer relationships as well. Typically, a borrower goes and makes an application to a housing finance company, and the next step is the preliminary screening of the developer. The preliminary screening includes studying the track record of the developer in terms of what is the quantum of project that he has delivered in terms of million square feet and the number of projects that he has done. As part of the preliminary screening, the reference check of the developer is also done through the peer developers. This also helps the lender to understand whether the financial strength of the developer in the informal market as well. The next step is the project site visit and the micro market analysis. In this process, the analyst or the underlying investment manager goes to the site and does a site visit of the project. In terms of the micro market analysis, they study what is the quantum of absorption that happens in a particular market. For example, if a developer is coming up with a project in Powai, the typical lender will study what is the quantum of sales that are happening in the Powai micro market. What is the typical typology of flats which are selling? Whether 1 BHK, 2 BHK, 3 BHK or 4 BHKs are selling. And what is the product that the developer is offering in respect of for which he is seeking the financing. The application of the developer also includes their funding requirements and the timelines by which they expect to complete the project and give delivery to the customers. The next most important step is to prepare a cash flow analysis of the underlying project. In this, the analyst makes a financial model and makes assumptions in respect of the underlying sales velocity, the phasing of the construction expenses, and the funding requirement, and makes a broad profitability or project economics calculations. Let's take an example. If a developer is developing a project where he is selling or he needs to sell a 1 million square feet of residential area, the analyst will then make an estimate of the micro market absorptions, the overall view on the real estate segment, and then project the sales of this 1 million square feet. Typically, he will phase the sales in 3, 4 or 5 years depending on the micro market. The typical, as we have explained in the earlier sections also, the collections are based either on the construction linked or subvention scheme, and basis the discussion with the developer, they project the underlying collections and the sales of the project. Post this, the sensitivity is also done on the cash flows in terms of an increase in the cost price, a decrease in the selling price, or delay in the project. This helps the underwriter to assess the cash flow at risk for a particular project. For example, a typical lender does a 10-10-12 or a 10-10-6 analysis for a particular cash flow analysis that is doing. In 10-10-12, he assumes that the sale price will go down by 10%, the cost of the project will increase by 10%, and there will be a delay of 12%. So what is the impact on the cash flows basis this, and what is the requirement of the construction finance, and whether the developer has the wherewithal to pump such deficit from his own equity in such a scenario. This kind of analysis forms fundamental analysis of the cash flows for an underlying project. The next important aspect of discussion with the developer includes the structuring of the transaction and the legal enforceability of the transaction. If the developer is developing a project in a land which is owned by government agencies, then from a legal perspective, an upfront NOC is required from such regulator or a government entity. For example, in Mumbai, a lot of land parcels are owned by MMRDA, and when a developer develops a project, an upfront NOC is required from the MMRDA to mortgage the land and for selling the flats to the home buyers. So these will become part of the underlying legal structuring of the transaction. The sales and collections milestones are agreed between the lender and the developer. There are specific milestones which are agreed in terms of the construction completion, the OC of the project, or if there are some pending approvals, the timelines are defined to get those approvals. In the next step, a draft term sheet is prepared by the lender and is shared with the developer, which captures the entire understanding of the construction finance loan. As explained, the term sheet will capture the quantum of working capital or the project loan that is required, the tenor of the loan, the conditions precedent to the first disbursement, the conditions subsequent to the disbursements, and also the various other covenants which are specified in a particular transaction. Once the term sheet is agreed by the developer, the construction finance team then goes for an internal approval to the higher committees, including the board, for the particular transaction. And once the approvals are in place, a sanction letter is issued which captures the terms of the construction finance loan. Once the term sheet is accepted by the developer, the internal risk assessment is done by the risk committee. This is very important from the compliance point of view, because the regulators would want to see the independent view of the risk committee in respect of any lending transaction done by the lending institution. Post this, the investment team prepares a credit assessment memo and presents it to the deal approving committee, including the board. The comments and observations of the risk committee are also incorporated as a part of the sanction. And once the deal is approved by the risk and the credit committee, the sanction letter is prepared and shared with the developer. Post the sanction, the lending institution goes for a diligence of the underlying deal through the impaneled vendors. Typically, the diligences include the title diligence, the valuation and the technical diligence of the project, and financial and commercial diligence of the project. As per NHB, valuation from 2 technical vendors are compulsory for any lending transaction. Post the diligence and comfort of the lending institution, the process of documentation is started, wherein the legal documents are prepared and shared with the borrower for execution. And post the execution of the legal agreements, the underlying security agreements, the loan is then disbursed by the lending institution. Some of the institutions also do a pre-disbursement audit before the first lending. The pre-disbursement audit includes the check in respect of the KYC, the AML checks, and other checks that are done as per the regulatory requirements. Post the pre-disbursement check, the disbursement checklist is prepared by the lending institution, and the same is signed off by all the departments, which include the business team, the compliance, the risk and legal, and the instructions is then given to the finance team to disburse the loan. So just to summarize the entire process for availing a construction finance loan from a developer's perspective, the developer, as explained, makes an application to a lender and outlines his track record in terms of his development experience, his team, etc., and also spells out the requirement of the project loan in respect of his project. Basis the preliminary screening of the developer, which includes the CIBIL check, the reference check from his peer developers, the underwriting team then prepares a cash flow model for the project and does sensitivity on the underlying cash flows, basis their understanding of the micro market and sensitivity in respect of the sales price, the construction cost, and the project tenure. Then the term sheet is prepared and the same is then negotiated with the developer, which captures the pricing from a developer's perspective, the tenure of the loan, the repayment schedule, and all other important terms and conditions. Once the term sheet is agreed by the developer, the lending institution goes for the internal sanctioning process, and once the sanction is done, they share a sanction letter and proceed for the due diligence and documentation. From a borrower's perspective, they need to, before they get the disbursement, they need to ensure that all the legal agreements agreed are signed and executed. The security package, which is agreed as a part of the construction finance, is also executed and shared with the lender. Post that, they make a request for the disbursement, and once all the internal approvals and audit checks are done, the lending institution then disburses the construction finance loan.